Hello, this is Professor Grant Thrall welcoming you to Market Analysis of Urban Built Environments. Module 1, Why Market Analysis? Who benefits from market analysis? Space markets, capital markets, market construction costs, market feasibility versus market analysis, importance of market analysis, and the market analysis process. Module 1, Why Market Analysis? Preliminary to the decision by stakeholders, market analysis must be performed. Market analysis might begin at a very high altitude, taking into consideration past, current, and future market conditions. The real estate investment decision must be supported by market analysis. Ultimately, real estate market analysis must be place-specific, thereby providing a firm foundation for the investment decision. The stakeholders' perspectives. The developer must know that there will be sufficient demand to support the project. The property user must know that the space is appropriate for their needs at the right location at the lowest possible total cost. The broker, to maintain credibility in the marketplace, must negotiate rental or sales agreements within the context of the market. The investor, the market analysis provides the necessary data to support feasibility analysis. Financial analyst, they evaluate the debt and equity investments in the context of the place-specific risk, and they depend upon the data provided by the market analyst. Government, elected and non-elected professionals must weigh the benefits of the project against the public wants and the spillover costs to the public sector resulting from the development. Property and capital markets. They're like gears that are meshed. We have the real estate transaction market and the rental market for real estate square footage. Market for space and the capital market. The relationship between the rental market and the asset market depends upon the net operating income and the cap rate, and together their ratio becomes the capital market value of the real estate asset. Often, particularly in multi-branch retailer, when considering a site for purchase, the market analyst evaluates the number of years to pay off. The number of years to pay off is calculated as the inverse of the cap rate, also calculated as the market price, which is the fair market price, ratio to the net operating income. This tells us the number of years to pay off. But the actual price paid by the investor might be more or might be less than the market price, depending upon the circumstances. These circumstances then give rise to go and no-go decisions. The calculation is used by stakeholders for the go or no-go decision. Based upon experience, an investor might adopt 2 years as a rule of thumb. In other words, if income net of expenses can pay for the property in less than or equal to 2 years, then experience of the investor indicates that the investment is worthwhile. Otherwise, the investment is not considered worthwhile in this example. Commercial real estate market equilibrium. If asset values are less than the construction cost, then there is a disincentive for new construction. However, if asset values are greater than the construction cost, then investors have an incentive to build. These diagrams are from Jeff Fisher, Susan Hudson Wilson, and Charlie Wurzbach, 1993, Equilibrium in Commercial Real Estate Markets, available in the Journal of Real Estate Portfolio Management. This information is based upon chapters 1 and 2 of Grant Thrall, Business Geography and New Real Estate Market Analysis, published by Oxford University Press, 2002. This will be continued in Module 2.